Well, moving on, we have a special guest joining us now. Edelweiss is in the news. It's got funding as Allianz Investment Management strategically invests in their private debt platform. To talk more about this, Rashesh Shah, the Chairman and CEO of Edelweiss Financial Services, joins us now. Rashesh, hi, good morning, and thanks so much for speaking with CNBC TV18. I'm going to ask you about this private debt segment investment in just a bit. But before that, I wanted your take on what's happening with the liquidity crisis, because at this point in time, it's not just a plain vanilla liquidity shortage anymore. It's now become a crisis of confidence, which has made a lot of financiers' own borrowing costs jump quite a bit, and now it's having its ramifications on different sectors like real estate, etc. What is your own thought on all of this?
Yeah, I think liquidity is still tight, though. I think RBI in the last few months has done quite a bit with OMOs and all to ease off liquidity. In the last couple of weeks, FIIs have again started selling, because every time FIIs withdraw money, it also creates a liquidity crunch. Plus, we are going towards election, so currency in circulation has also gone up, which also affects the liquidity, because the more liquidity in the banking system, the more it flows easily. So I think all of those factors are keeping liquidity very tight. Our expectation is that until March, when we get to the end of the year, we should expect a very tight liquidity environment, and then obviously April and May will be election time. So I think the next 3-4 months, most of the players should position themselves for a much tighter liquidity environment. And in the tight liquidity environment, a few things always come to the edge, which has always happened. So unless the liquidity situation eases off, and I think RBI has done a good job in the last 3 months, but I think we are hoping that with more OMOs, maybe a CRR cut or something like that will help really ease and pump in a lot more liquidity that the Indian economy needs at the moment. But for this liquidity itself, we are seeing a lot of foreign capital coming in. So foreign capital in equity markets may be going out, but we are seeing foreign capital coming in the credit markets, in the debt market, because everybody thinks interest rates are going to come down, Indian rupee is very stable. So for a lot of credit investors, it's a very big plus, and actually that is where we have got large investors like Allianz, who have invested $200 million in our stress fund, because a lot of the large global players now are looking at credit opportunities in India.
Sure.
Until last year, they were still hesitant because the rupee was weakening and interest rates were going up. But now with the interest rates coming down, expected to come down even further, and easing off and easy pressure on the rupee, we will see a lot more investments in the credit markets in India.
Rashesh, good morning. It's very interesting that you say that and talk about this foreign interest at a time when the credit market in India is going through its own motions, its own doldrums. I mean, we have issues like credit quality after Island FS, who's paying whom, where are the defaults happening, where are the payment delays happening, pledge shares, and so much more. There's so much happening in the credit market, right? So how are you looking at some of these concerns? And I mean, I'm not getting to specifics, but we very well know the issues that one particular corporate conglomerate has raised, with Edelweiss being one of the lenders, L&T Finance being the other lender, with respect to whether a pledge can be invoked or not. So these are some very heady issues that the credit market is witnessing.
I would think so, but again, if you look at the amounts and the numbers involved, they are much smaller. See, you should keep things in perspective. India credit markets, we had almost about 200 billion, about 12-13 lakh crores of NPAs in the system over the last 5-6 years. A lot of them have got cleaned out, they were provided through IBC, through NCLT. A lot of NPA, as the crisis is over. So given what we saw in the last 5-6 years, I think what we are seeing now, the numbers are very small. It's about a few hundred crores here and there. Of course, ILFS has been a big number, but post ILFS, what we are seeing is more. I think there is a lot more noise in the media, but from a credit market overall point of view, the numbers are very small. And I think given what has happened in India in the last 5 years in credit markets, with NPAs, with IBC coming in, with the changes in the bond market that we are seeing, with the changes that we will see in the mutual fund approach to credit, all of that, there is a new wave. If you look at even equity markets in the last 25 years, after every upheaval, whether it was Harsham Mehta, Ketan Parekh, whether it was 2008, whether it was the duplicate shares issues and all, we got dematerialization. The markets have actually become stronger, and our hypothesis is that given the upheaval that we have seen in the last few years and the current liquidity crunch that is there, this is a great time for a lot of foreign investors to come into Indian credit markets and take advantage, because India is still a credit-starved market. So a lot of foreign investors can also be one more avenue of providing credit to Indian economy in other means. So along with banks, along with NBFCs, along with mutual funds and bond market, now the foreign players will also become credit providers to India.
Okay, one final question then. The focus has been a lot on lenders right now, but do you see a bigger spillover when it comes to borrowers? I mean, in the sense, do you see defaults become more rampant as NBFCs are forced to curb their exposure, to real estate players, even the ones that are fulfilling the repayments?
I think unlikely. As I said, India has gone through a very large NPA crisis as an economy of almost 12-13 lakh crores. Compared to that, all the other numbers we are talking about are fairly small. And India, whether it is real estate or whatever, we have gone through demonetization, we have gone through GST. Now the recent change of, if they change GST to 5% for under construction housing and all, that will be a big boost for real estate. So if you look at last year, home sales were fairly stable. Home loans, disbursement from banks and other housing finance companies more or less is still very stable. So as long as the end user demand is there, as long as the economy is growing at 7 to 8%, and we are in a phase where we might be in a expansionary fiscal and expansionary monetary environment very soon. I think the second half of this year, we will see expansionary fiscal and expansionary monetary policy, which will be great for the economy. So I think there is maybe an immediate liquidity tightening environment for the next few months, but after May, June, we will see a lot more expansionary environment, and that will be very good. So currently, economy itself is not in a bad place, but as you said, there is a liquidity tightening, some crisis of confidence, but it is also starting to pass. I think things in October, November were much worse. Now they are easier, and the numbers we are talking about are very, very small. It's about a few hundred crores.
Okay, well, that's a good optimistic note to, wrap this up on. Rashesh, we would have loved to chat more maybe some other time. And, you're talking about foreign capital coming into the credit markets. Incidentally, the rupee is actually gaining as well. It's across 71. So that is the view from Rashesh Shah, someone who sees these things from close quarters. With that, we're absolutely out of time. The equity market is still in the red, but lots of trading ideas coming up for you on Chartbusters.